The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
PCE data hits the mark and Wall Street traders hit the road. From Studio 2 here at Bloomberg headquarters in New York. Did you like that?
Yeah, I did.
I'm Romaine Bostick.
And we're here, of course. We didn't hit the road yet.
Yeah,
I'm Scarlet Fu. Alex Steele did hit the road. She's off today, but we're kicking off to the closing bell here in the U.S. This is where things stand. Another day of modest moves, basically wrapping up a week in which the S&P 500 did not close higher or lower more than 0.6%. So we're well within that range. However, you look at the Magnificent Seven recovering from a 4-day sell-off, up 0.9%. NVIDIA, in particular, rebounding from a sell-off sparked by its insufficiently bullish outlook. We're looking at sharp declines in NYMEX crude. In fact, it just deepened. It's now off 3.33% for WTI at $73 a barrel. Several officials within OPEC Plus do expect production increases to go forward this year, and we are seeing Treasuries decline. That is pushing yields up. And so when you look at the spread between the 2-year and the 10-year, what's happening is it's continuing to steepen, and that gap is now just under 2 basis points, moving towards a normal positive slope for Maine.
Yeah, of course, as we head into that Labor Day weekend that some folks have already headed into, fitting to take a look back at the month was here on the last trading day of August, a soft end, if you will, to an otherwise solid month for global stocks, a rally that largely occurred without any meaningful contribution from the Mag 7 or from chip stocks, each of those two groups posting declines on a monthly basis. And that actually might be a good thing. Signs of better breath for a broadening rally amid bets that the Fed has tamed inflation without tipping the economy into recession. In fact, just this morning, we did learn that the Fed's preferred measure of underlying U.S. inflation, that so-called core PCE, advanced last month by 1.7% on a 3-month annualized basis. That's the slowest pace this year. That same report also showed inflation-adjusted consumer spending accelerating. That should check a key box for Jay Powell and the prospects for interest rate cuts starting in 2.5 weeks' time.
To me, this is a pretty good mix of data. Now, there are those downside risks, of course. You know, the unemployment rate's much higher in that last report. So we have to watch these things closely, particularly in the labor market. But overall, I think a pretty good tone of data.
And as far as the individual stocks moving today, you have some interesting players out there. Some big losses for some of the discretionary names like Ulta and Royal Caribbean, but outsized gains for old school tech like Dell, like Hewlett Packard, and Intel. Intel actually rallying the most intraday since 2022 on the back of a Bloomberg report that says CEO Pat Gelsinger is considering strategic moves that could splinter off its foundry business, a division, Scarlett, that had been both sort of an in-the-moment albatross for the company, but also was supposed to be that bright spot long-term.
Yeah, well, it's proving to be a bit of a bright spot today, at least these reports. But let's go back to the overall price action in stocks, which continue to make new highs. It just depends on how you slice it, right? The yellow line tracks the 67 infotech companies in the S&P 500, and it's up 43% over the past year. But the group has never fully recovered from that sell-off in early August. That's compared with the S&P 500 itself, which is in blue, which has gained considerably less than the tech names since last August, but it's about 1% shy of its all-time high. And definitely in contrast with the S&P equal weighted index in white. Clear laggard here, only up about 19% for the past 12 months, but it is setting new highs. That's a clear sign investors see more prospects for upside in other sectors outside technology. For instance, like financials and industrials, Romaine.
Yeah, absolutely. Here, as we kick you off to the close, we remain with that focus on the macro. We talked about that PCE data we got this morning. We get a big jobs report in about a week's time, and now we're learning some companies already front-running that. Goldman said to be cutting over 1,300 jobs, or about 3 to 4% of its workforce. This according to a report by the Wall Street Journal. According to that report, Goldman cuts have already started, and they will continue through the fall. It says that the cuts are part of an annual review that cuts low performers. Again, the headline number, though, here is about 1,300 workers, or about 3 to 4% of the workforce over at Goldman Sachs. This, according to a Wall Street Journal story. We're going to get you some more details on that, and I'm sure we'll return to that story before we get to those closing bells. We do want to stick, though, on that broader topic, that broader theme, really, about the health of the economy and how it folds in to the positioning that portfolio managers are making. Joining us right now is portfolio manager and senior analyst over at Westwood Management, Miss Lauren Hill. Lauren, thanks for being here on the program, and really kudos to you for working this day before the Labor Day weekend when everyone else is hitting the road here. I do want to get your take, though, on economic conditions, because as a portfolio manager, you obviously have to have an eye on the macro. And the narrative for the last few months has been the macro is at least resilient, if not exceptional. Do you expect that to change?
This remains. So as long as unemployment remains intact, I think that the economy will continue to hum along. We are seeing some weakness, though, within consumer discretionary. Consumers, in particular, are starting to really increasingly seek value. We heard that from dozens of retailers the past couple of weeks during earnings season. They're also trading down, delaying purchases, and going without in order to just maintain slightly tighter budgets.
Well, that's what I'm curious about, because when we looked at some of the earnings reports that we got over the last couple of weeks from the retailers, probably the one that stood out, of course, was a commentary by Dollar General that seemed to suggest that what you just said, the low-income consumer really is retrenching. When you look at middle-income consumers and then even go up a little step above that to some of the kind of higher net worth individuals, are we seeing softness there as well?
Yeah, not from the high income folks yet, but the inflation that we've had over the past 4 years started to lean on the lowest income folks a couple years ago, in fact. And so there was actually a back to school shopping survey that came out in July, and the intention for the lowest income folks was to cut their spending 4% this year. And that's because they had already tightened last summer. What's interesting that's happening right now is that middle income group is now joining them in the belt tightening. So that group's intention was to spend 9% less. And so from the survey from parents, they thought that the big cuts would be more in the high ticket items and the more discretionary items such as tablets and laptops, but we actually saw a really strong comp from Best Buy, up 6% for that category. So that remains essential for school-age children and off to college kids. So we're really seeing a little bit more pressure more on the apparel and footwear side.
So given all of this, Lauren, how are you adjusting your portfolio with this kind of bifurcation of how the consumer is spending and where they're spending their dollars?
Yes, that remains a very important theme. And so the names that are more exposed to that upper income consumer continue to have steadier results. And then those kind of in the middle income are starting to feel that pressure. So that's a group that we've really avoided. We've been positioned a little bit more towards the highest quality names that are also trading at very good values. We continue to really like Walmart. There's, just certain names that really stand out to us as long-term market share winners in this environment where consumers continue to seek value.
What's the number one question your clients have for you when you talk to them about how the market is likely to shape up through the end of the year?
Yes, our clients are concerned about the consumer. A number of them own large real estate portfolios, have exposure across different income groups. So they really come to us to get that broader picture and to understand, the 40,000-foot view of what's going on in the economy, and then also to talk about their portfolio and their equities. So we've been telling them about the different themes that we're seeing with the consumer and the shifts in the spending, mostly by income cohort this cycle.
So kind of put this all together for it, Lauren, because mostly everyone pretty much assumes we are at the precipice of a rate easing cycle that will start at the Fed's meeting on September 17th, 18th. If they're doing that rate cutting against the backdrop of inflation that appears headed towards 2%, a relatively resilient consumer, but with everything that you've just talked about, this idea of softness approaching, should they have started cutting earlier?
I think they should have started sooner, but the Fed goes off the data, so we'll see how things progress. But really, the key to me is employment. So as long as unemployment's not rapidly rising, I think we're going to be in really good shape as an economy, as a country. But if we start to see unemployment really tick up, just as consumers aren't shopping to as great a degree and management teams are forced to protect their margins with layoffs, I don't think that anyone laid off is going to be so easily absorbed and find that next greatest job.
Yeah.
So hiring is really, really the concern this cycle.
All right, Lauren, great stuff. Lauren Hill, portfolio manager and senior analyst at Westwood Management down there in Dallas. And just a reminder, we do, of course, get that big monthly jobs report 1 week from today, an unemployment rate that, at least for now, still holding at 4.3%. Coming up here on the big program today, well, we're going back in time to the 2000s, why one analyst is saying Abercrombie & Fitch has had one of the strongest turnarounds in retail history. We're going to talk about it in just a second.
Plus, European football, the NBA, now the NFL. What's next? Little League? We're talking about institutional investors and how private equity is increasingly investing in the lucrative youth sports sector.
And for those of you still sitting in your offices watching us, well, what are you waiting for? Get out there on your planes, trains, and automobiles, because everybody is hitting the road for the Labor Day weekend. We're going to check in with Becky, Blaine, travel industry editor over at The Point Sky. All that and more coming up in a bit. This is The Close on Bloomberg.
Is today's PCE data point a sign that markets are in a Goldilocks environment? If you look at core PCE, which is, of course, the Fed's favorite gauge for inflation, it did come in line with expectations for July month over month and just a tick lower than expected on an annual basis. The good results seeming to set the stage for an imminent rate cut from the Federal Reserve. So here now to give us her perspective is Courtney Shupert, economist with MacroPolicy Perspectives. So what's your take, Courtney? Are we in a Goldilocks environment with this latest batch of data?
I think so. PCE inflation data, as you said, came in mostly in line with expectations, which is encouraging for the Fed that the Q1 spike in inflation data that we saw has mostly reversed now. And actually on a 3-month annualized basis, PCE inflation, core PCE inflation is now back to where it was in June 2020. So that's really exciting. And the consumer still appears to be pretty healthy. We actually saw, pretty strong real goods spending in July, and the economy is not falling off a cliff. It doesn't appear to be overheating, but like you said, the Goldilocks scenario for inflation is happening. It's moderating at a relatively benign pace.
I know no one wants to hang a mission accomplished banner just yet here, but how does this influence investors' sentiment heading into next week's jobs report?
I think it should be encouraging and affirming too. So we've already heard from Chair Powell at Jackson Hole that the Fed is, the time has come for policy to adjust. And so, we know that the Fed is paying attention to the inflation data, but they'll be responsive to labor market weakness. So the Chair Powell has communicated that. And so once we have the data next week, I think it should give the Fed confidence to go ahead and begin adjusting policy to a more normalized rate.
I am curious. I mean, when you look at, based on the data that we have now, and I'm talking specifically about the labor market data, and you look at some of those rolling averages, Courtney, is that painting a picture of a labor market that is still in favor of the worker, or has that balance of power shifted a little bit back to the employer?
Sure. So I think, we are definitely seeing some moderation in labor demand. Our firm does a scraping of earnings calls to see what firms are saying about their hiring and layoff plans. And we've seen that hiring plans have definitely slowed, right? So there's not as many job openings as there used to be compared to like a year ago or 2 years ago when the labor market was really hot. Right. So, employers are being able to take their time and to be a little bit more picky with hiring now. So there's definitely a number of dynamics that are shifting.
So what does that mean then? When we talk about an rate easing cycle coming off of 5.25%, I wonder how far can the Fed go? I mean, we're not returning to zero bound rates, or are we?
Well, I think wherever neutral is, we're not there. We know that policy is currently restrictive, right? And so when policy is restrictive, the labor market is not going to be normalizing or stabilizing, right? The whole point of having restrictive policy is that it's going to slow down demand. And so we think the Fed has pretty good room to cut We're expecting, at least a steady sequence of cuts this year and probably early next year to take the edge off, right? So that way we can see, once the Fed gets, takes 100 basis points off the policy rate, for example, then they might be able to go at a slower pace. But it really depends on labor market data. Inflation data is back into a more normal range. And so the Fed can really pay more attention to the labor side of their mandate.
When I look at the economic surprise index, and here I'm pointing to Citi's economic surprise index, it's currently at the highest since about mid-June. The thing about these surprise indexes is that we know they self-correct. When economic data beats analyst estimates, then economists tend to ratchet up what they expect, and then it goes in the other direction. Have we gotten to that point yet where economists are feeling more and more confident that, the data might actually undershoot what people are expecting?
I think in particular, the labor market data in July was really kind of shocking for some people, right? It was much lower than consensus was expecting. And so I think there's, we have to pay attention to that. And, if there's some noise, some storm effects, we can build that in as payback moving forward. But we have to also look at, the unemployment rate has consistently been rising. And so we have to take at least some signal from that. And then I would also say that, for the Fed, in responding to that, we're already at lower levels of inflation and higher unemployment than they were expecting earlier this year, right? And so that gives them room to go ahead and move rates lower too.
All right, Courtney, great stuff. Courtney Shupert, economist with MacroPolicy Perspective, a closer look here at the core PCE data that came out this morning and a closer look ahead to what we might get out of the labor market data 1 week from today. Meanwhile, there was some interesting data that came out, Scarlett, about U.S. labor market growth long term. The expectation is that we're going to see growth of about 0.4% a year through 2033. Here's a catch, though. That's less than 1/3 of the pace that we had in the preceding decade. You worried?
So wait, what changed, though? Are we aging? Is that part of it?
Well, it's population growth. The population growth is slowing. Basically, yes, people are aging out, and not only if younger people are coming into or being born or coming into the workforce, and that's going to be a potential drag on labor force participation.
You wonder how much immigration then factors in and what policy comes out of whatever administration takes office next January.
Well, I'm glad you brought that up because this is kind of the thing nobody really wants to talk about, that the labor market strength that we've been seeing over the last few months, a big part of that has been immigration related. Of course, I don't think you're going to hear any candidates on the trail tout that just yet.
And it's not necessarily always showing up in the data either.
Yeah, absolutely. All right, when we come back here, we're going to take a closer look here at one of the better turnarounds that we've seen for a retailer in history. Abercrombie & Fitch, remember them? Well, they're back. They're doing it like no other retailer, at least according to the analysts over at Citi. We're going to talk to that person in just a second as part of our top calls. That's coming up next here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations. And we start off today with Marvell Technology, the diversified chip maker receiving some good market reaction after boosting its third quarter outlook. Rosenblatt keeping its buy rating, but lifting its price target to 120 from 100. The idea here that Marvell can better capitalize on AI demand. Those shares having a phenomenal day, up about 9%. Next up, let's take a look at CrowdStrike, upgraded to buy over at HSBC. We talk about that global IT outage in July. Well, the analyst over there says that's now, quote, behind us. He says the security company's outlook implies robust growth trends ahead and its long-term prospects still intact. Those shares up about 1% on the day, and we should point out, going to close out the month of August higher by 19% despite the earlier sell-off. And let's end things here with Kohl's. More style, more savings may not be resonating with middle-income consumers. That's according to Oliver Chen over at TD Cowen, saying that the challenges in the retailer's core apparel and footwear branches could continue to impact pricing and promotions in the second half of the fiscal year. He's downgrading Kohl's to hold from buy. The shares, taking a leg down by about 3% here on the day. And those are some of our top calls. All right, we do want to stay in the retail space here because one retailer that doesn't seem to be struggling with its consumer appeal, Abercrombie & Fitch, one of the best performing retail stocks of the year, up more than 60%. Citi citing 10 reasons why the company's turnaround story and sales momentum earned it a buy rating today. The man behind that rating joining us right now, Paul Lejuez, head of America's consumer discretionary sector over at Citi. Paul, this has been a phenomenal story. We've spoken with the CEO, Fran, a few times here, trying to get some insights on how she did it. I guess the question I have for you is, how does she keep this going?
Well, I think what Fran has done over at Abercrombie is remarkable and is one of the best turnarounds that we've ever seen in the history of retail. You have to remember that this was a low single-digit EBIT margin business prior to the pandemic. Even as recently as 2022, this was a low EBIT margin business, low single digits, and she has really got her finger on the pulse of the consumer. You know, retail sometimes is as simple as getting the fashion right on a consistent basis and matching that with the right marketing message. It's not easy to do, but that is what she's been able to do over the last several years. It's been just an unbelievable turnaround story that we really are so impressed with what they have done. And we think the best is yet to come. You know, as good of a performer as it's been, we think it's still headed much higher, and we think the pullback this week has given investors an opportunity to buy this stock.
Okay, so Paul, you give 10 reasons, and number 7 on your top 10 list is balance sheet is pristine, no debt. Talk a little bit about that, because of course the growth that Abercrombie & Fitch has shown is exciting. Will the company be tempted to take on debt, or need to take on debt to sustain that growth rate?
No, not at all. They are extremely free cash flow positive. They've got a free cash flow yield in the high single digit range. That's our forecast for the next several years, high single digit yield annually. They just paid down the remaining debt that they had. So really they're not showing any signs of taking on more debt necessarily. And what we really are excited about is we think that this big cash position that they've got building, we estimate about $1.2 billion in cash by the end of the year, combined with their strong free cash flow, is going to allow them to become a lot more aggressive from a share repurchase perspective. So we expect that to be a bigger part of the story over the next several years and really help drive mid-teens EPS growth over the next several years.
I'm sure there are a lot of retail companies out there, Paul, that would love to have their version of Fran Horowitz come on board here. We talk about Abercrombie & Fitch being one of the best retail stocks this year. One of the worst is Lululemon, and we got some results out of them the other night. I know you cover this company here. What can fix their problems right now?
Yeah, I mean, we're neutral rated on Lulu. You know, they've run into a bit of a rough patch. I think, the history is important. They really benefited from a shift towards athletic and athleisure during the pandemic period.
Right.
But I think closets are somewhat full with that sort of product, and there's been a wallet shift more towards the fashion that Abercrombie is selling. So I think it's just a matter of wallet share currently, and at some point, maybe the trends go back towards athletic and athleisure, but right now, trends out on their side.
Yeah, especially with the wide-legged pants. That's really popular. Paul Lejuez over at Citi, thank you so much. Coming up, we'll talk about private equity looking into youth sports. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu.
I think we're the only two people in New York City still working right now, Scarlett.
We are, definitely feels like in this office.
Yeah, we should point out, obviously, we're heading into the Labor Day holiday weekend here in the United States. This is also the final trading day for the month of August. It's been an interesting month here. I mean, major indices holding on to some modest gains, the S&P up about 1% here. One thing I thought that was interesting about it is that you didn't really see the huge Mag 7 stocks lead that charge this month. It was names like Kellanova, Fortinet, Starbucks, Clorox was up 20% this month.
Yeah, it's a complete shift from what we had seen earlier this year.
Yeah.
And it really speaks to how investors see more value in other kinds of companies outside of the AI space.
And it was interesting, too. We talk about some of those big names. Of course, one of the Mag 7 is one of the worst performing stocks of the year, and that's Tesla. They're also down here in the month of August. But some news crossing the wire just now that maybe actually might help the stock perk up. That robo-taxi that Elon Musk has talked about forever. Well, according to our reporting, he's finally going to unveil it on October 10th at an event in Burbank, California, on the Warner Brothers Discovery's movie studio lot. That's according to people familiar with the matter.
He has a flair for showmanship. You know, do it in Hollywood, right? That makes a lot of sense.
Yeah, well, it'll be interesting. I mean, obviously, this was one of the big barnbuster stocks. It's a bit on the back foot, probably because he hasn't really articulated a long-term plan for new models and new releases. So maybe on October 10th, that could potentially change.
There's still a long time to go before October 10th as well. You talk about big winners. Some of the big winners this week was the handful of private equity firms that got the green light to invest in individual NFL teams. But the buck doesn't stop there. PE is also drawing up plays to capitalize on youth sports, which is booming, with annual spending of at least $30 billion, according to the Aspen Institute. And that's because families are shelling out $900 per child every year to have their kids compete athletically. Joining us now for more on the youth sports industry and private equity's role in it, Tom Farrey, founder and executive director of the Aspen Institute's Sports and Society program. Tom, it is so good to speak with you. You know, that $30 billion figure is actually at a minimum. And that's how much people spend annually on youth sports. What does the growth trajectory of that look like over the past, I don't know, say 30, 40 years? I imagine it's like a hockey stick.
We don't have exact numbers on it, but it has been like a hockey stick. What happened was in the 1990s, the travel team industry really became a thing, starting with Disney's Wide World of Sports in Orlando. And since then, we've seen the growth of these what are called megacilities around the country, which has powered youth sport tourism, wringing lots and lots of money out of many families out there. So it's been huge. We'll see what the future holds.
Okay, and now private equity is taking a good close look at youth sports as well. Can you give us a sense of just how big a presence PE has in youth sports versus, say, mom and pop businesses? Are we talking like a 20-80 split or something more like 40-60?
I mean, PE is new to youth sport. Youth sport has been dominated by the local mom and pop. So only in the past few years have the private equity firms actually gotten into the space. And we'll see what they do. I mean, we're going to see more and more of this going forward. There's going to be consolidation. So whatever that percentage figure is, it's going to grow. And it'll grow significantly.
Where does that money actually go, Tom? I mean, what's the breakdown here? I mean, is that money going directly into the leagues, or is it going into training facilities that are kind of independent of that? Where?
Well, I mean, if you're, and I was one of those travel team parents. If your kid's playing soccer with a club, it's usually a $2,000, $3,000, maybe a $5,000 registration fee to that local club. But then you have the weekend tournament. So that's where you really amp up the dollars. The hotels, the air flights, the gasoline, the meals on the road.
Yeah. Yeah, you know, I mean, I'm as someone with a teenager who's going through this right now, Tom, I definitely feel you. And let me just state for the record here, it's a lot more expensive than $2,000 to $3,000 than maybe what it was back in the day. I am curious, though, as to what this could potentially mean for the kids and their parents. Are they going to be able to share at all in this potential upswing in money coming in, or is this just more just play like a kid and maybe you profit from it once you make it into college and into the pros?
Well, I mean, the whole industry is based upon this idea that if you invest in children in a significant way, you give them high doses of sport starting at 6, 7, 8 years old, then your kid's going to have a chance to play in college and maybe have a chance to play in the pros. Now, what happens is often parents get to when their kid's in like 10th, 11th grade, and they realize, oh, there's actually not a whole lot of payoff here. There's not actually a whole lot of scholarship money waiting for my kid. Maybe there's preferential admission to a selective college that can be leveraged, but the real return on investment is what sport does for a kid's life. Are they more connected to their friends? Are they, is it protective against mental health? Does it, create an active lifestyle? That's what that's what parents and kids should be focused on. That's the real return. So.
I like the way you put that. So that's a real return for parents and families who are shelling out all that money. What's the return for institutional investors who are then going into it? Because PE firms tend to have a timeline of 3 to 4 years, then they got to show a return on investment. With the money that's coming in to youth sports, how do you see that changing the experience for families and as well for the industry at large?
Look, I mean, I think private equity could either be the best thing for youth sports or the worst thing for youth sports. It'll be the worst thing if private equity comes in and says, okay, well, let's do what we usually do with a lot of industries and try and cut costs and wring as much money out of the space as possible. because that's going to be, they're going to be trying to pull more and more money out of a smaller and smaller group of parents who can afford this experience. It'll be a good thing if they come in there and they apply professional management and they lift the standards with which coaches are trained, program standards in terms of age-appropriate play, et cetera. I'm interested to see if they have the intelligence, the imagination, and the patience to expand the number of kids who are experiencing sport in this country and building business models off of that.
All right, Tom, great stuff. And this is a real fascinating case study, I think, for a lot of us who are parents and have kids of a certain age. Tom Farrey is a founder and executive director of the Aspen Institute Sports and Society program. And I don't know how I feel about this, Scarlett. I mean, I know youth sports isn't really youth sports like it was when we were kids. It's big business, but to kind of see private equity get into this, it just kind of feels, I don't know.
Well, I mean, there are a lot of things that they could improve upon, because if it's individually family-run businesses, there's a lot of efficiencies. A lot of these youth sports leagues are not technologically advanced in any way, right? Like, I mean, sending out schedules is a nightmare, for instance. So maybe like little things like that can be improved on the back end. Yeah, and you see, like they make us like go on these little apps to get into the tournaments, and they're all like off. I think it's like literally it's like designed on like a MySpace platform. There you go.
20 years ago.
We've all felt the pain.
All right, coming up here, we are going to talk tech. We are going to talk Intel, and a big scoop by Bloomberg News that Pat Gelsinger, the CEO over there, looking at some alternatives to kind of goose the stock price, and that could mean a separation of its foundry business. That discussion coming up after the break. This is Bloomberg. Time now for our stock of the hour, and it is Intel having its best day going back to October of last year on the back of a Bloomberg report that says Pat Gelsinger looking at some options here to try to create some value for the company. Ian King joining us right now, the sage of covering this company out in our San Francisco bureau. What exactly, Ian, does Gelsinger have planned?
Yeah, what we've reported is that, and it's important to stress that this is very early days, that the company is going to discuss a number of options that are a departure from its current policy. Those may include a separation of its two main businesses, products and manufacturing, and then it may well scale back some of its expansive plans in terms of building new factories.
Well, that's what I'm curious about, because all the chatter over the last couple of years has been about the money that Intel has gotten from the government, or at least committed to by the government, the idea of doing more manufacturing here, and the idea that Intel would be a focal point of that. If the foundry business is spun off or separated in some way or another, does that alter those plans?
Yeah, I mean, it obviously does. I mean, anybody who's been listening carefully would have heard Intel say the magic words, which is, hey, we'll build according to demand, we'll build capacity out according to demand, which is a traditional way you do things in the chip industry. You build a factory shell, and then you only put the expensive equipment in there when you're sure that you can actually have that equipment working, because it's so expensive. The government are obviously aware of that, and they're not going to give Intel any money until it does what it said it was going to do.
Ian, with your decades of covering the chip companies, first in Asia, I know you covered.
Are you calling him old?
No, I'm just saying he's experienced.
Oh, okay.
I'm old.
You covered Samsung Electronics of Korea, TSMC of Taiwan, and now Intel. I mean, these were the big chip makers of their respective countries and of the world. Yet we've seen Intel fall behind quite a bit. What was the thing that Intel didn't do to keep up?
Yeah, and people are talking about, Gelsinger's future here, but I think it's important to remember that he inherited a very difficult situation. The problems that Intel has right now are the result of decisions that were made by his predecessors, technology decisions, what they were going to do with manufacturing technology, the choices that they were making with regards to where they were emphasizing products. And all of that has added up to a situation where we're in now, where we need a lot of money to revitalize this company's technology, but we have less money because the products that we're selling right now aren't as good as they should be.
Yeah, it creates a moment of truth for Pat Gelsinger. What is your confidence that he will be around to see through whatever decision the company makes?
That is something that the board will have to decide. I think, broadly speaking, people believe that he came up with the right plan. He's just been unlucky in a lot of regards, and also the timing of everything. I mean, people want returns, they want a sign of progress much more quickly than we've seen. At the moment, there's a sense that things are actually getting worse. That's a very difficult situation to be in as a CEO, regardless of whether it's your fault or not.
This gets to the question too, Ian. I mean, this has been a year where we've seen activist investors really come out the woodwork for a lot of companies. I know there's been already a couple that have kind of kicked the tires on Intel. Does Pat Gelsinger really need to prepare himself for more?
Good question.
Well, the typical activist playbook is slash and burn, right? That you come in, you see an undervalued asset, and you somehow force the management team or replace the management team to create value, and that there are cost cuts and everything else involved. That's not what the problem is with Intel. The problem with Intel is, if anything, it needs more money, it needs more investment. So who's to say? I mean, look at the share price. Of course, that represents an opportunity if you're an activist. Yeah. But are they going to be there and give Intel the money it needs?
Yeah, all good points. Intel shares up 8.5% today, but for the year, it's down 56%. Ian King joining us from San Francisco. Thank you so much.
Company's 56 years old, too.
Yeah.
Symbiosis here. I am curious, though. I am serious on the activist thing, because, I mean, this is like ripe for it, right? I mean, when you start to hear this, you're talking about a guy who's coming up, I think, on his 4-year anniversary as CEO at the start of next year here. So a lot of questions here about what needs to be done.
Absolutely. All right, we're counting you down to the closing bells with Mark Newton, Managing Director and Head of Technical Strategy at Fundstrat. We'll get his take on whether tech needs to lead this market higher. This is The Close on Bloomberg.
Welcome back to The Close. Romaine Bostic here alongside Scarlett Fu. We want to get back to that breaking news on Tesla that we had just a little while ago. Bloomberg reporting that the EV maker is now prepared to unveil its highly anticipated robo-taxi. Elon Musk setting up an event at the Warner Brothers movie studio lot for October. Dana Hull joining us right now to talk a little bit more about what we know. Dana, what actually do we know about this event?
Well, not a lot. I mean, we knew that the event had been postponed from August to October, and that was a scoop that Tesla confirmed on its last earnings call. But we were trying to figure out where, and we were able to report today that it's going to be at the Warner Brothers studio lot in Burbank. And there's a lot of reasons I can think of as to why this might be, but that's the big news today is just that this event is going to be there.
So the big event is going to be there. Tesla, if I recall correctly, moved its headquarters to Austin because Elon Musk says it's a better place to do business, but he chooses to do a lot of his big showy unveils in California. What does that say about his approach?
Yeah, well, it's important to remember that Tesla's design studio has always remained in Hawthorne in Southern California. And, automotive history is very much part of California history. A lot of the designers that work at Tesla are still in Southern California. And LA is where, you have like high production value people. A lot of big events are done in LA. And so I think it makes sense for this robotaxi, which is all about kind of innovation in the future, to happen here in California.
I'd be remiss in not pointing out that Musk has taken the stage before with some of these prototypes for various things. Of course, we all remember that robot that wasn't actually a robot. I guess, how real is this going to be? Meaning, once he unveils this thing, assuming it does happen in October, when do you think that thing will actually be on the road, we'll be able to touch it and get into it?
I think it's still going to be quite a while. What's interesting to me is that, if the Warner Brothers lot is a private lot, so this is not a public road. So whatever they are unveiling, this prototype, this product launch, this demonstration of its capabilities is happening on private land. So they don't actually need like a permit because they're not testing on a public road. So I think it's going to be quite a while before we see regulatory approval and, and a whole ride-hailing fleet.
All right, Dana Hull there with the breaking news on Tesla, set to finally unveil a prototype of its robo-taxi sometime in October, according to people familiar with the matter. There's some other breaking news also involving Elon Musk and his other company, X. That service, of course, the company formerly known as Twitter, has now been suspended in Brazil. Of course, there's been a long-running dispute there between Elon Musk and Brazilian authorities that has now resulted in X being suspended in that country. We should point out, though, Scarlett, Tesla shares right now are hitting session highs. In fact, stocks across the board right now hitting session highs as we get closer to those closing bells.
Yeah, I was taking a look at this. You have the S&P 500 now up 0.9%. I was going to say that it was going to be another day of modest moves, but that's no longer the case here. And it's a move across the board higher. And you can see a lot of green there with the NASDAQ 100 outperforming, up by more than 1%. Treasuries are still lower. You could see the 10-year moving up by 5 basis points. And that's been a trend all week long, with the long end moving quicker than the short end.
But you're seeing volume pick up there. And obviously some of this is probably just a little bit of that to sort of month end closing out trades, putting in new ones here, as you typically see at the end of a monthly period.
All right, so let's talk a little bit about where things stand at the end of this week and month. And welcome Mark Newton. He is Managing Director and Head of Technical Strategy over at Fundstrat. So Mark, interesting that we get a day in which there's not a whole lot of trading activity, given it's a Friday before Labor Day, and you have markets moving to their highs of the session. What is the sentiment? What is the mood of the market right now as we head into a long weekend in which things should start to pick up in terms of headlines, in terms of any kind of corporate announcements in the following days?
Yeah, thank you. Look, it is a week that's very reminiscent of a pre-holiday week. I mean, markets have been very range-bound throughout the entire week. I think both bulls and bears are sort of disappointed. But I would note that we do have 5 sectors that are set to make new all-time monthly high closes as of today, so the end of August. And so I think that's very impressive. We see, industrials, healthcare, financials, utilities, and also technology. Tech, of course, was hit hard during the early part of the month, but has managed to rally back. I think that's very encouraging. When you talk about sentiment, we have slowly but surely gotten a bit more optimistic, and that will be something to watch as we get into the so-called seasonally bearish month of September. But during election years, September is really not as bad as advertised. Typically, it's a better month than October. So I don't necessarily think it's a time to, sell and go away like you do in May. I think, if anything, we need to see evidence of these trends starting to break down before investors should get a little bit more cautious.
You mentioned technology in your breakdown of the different sectors. If you look at the S&P 500 Infotech Index, it has not yet recovered to the levels it was at before that early August meltdown. How critical is that for the S&P 500, the market cap-weighted S&P 500, to be able to reclaim its record high?
Look, the eco-weighted S&P has already moved to new all-time highs, and I think that's important. It is important for technology to continue to perform well. However, like in the last month, it's lagged, but all these other sectors have rallied to pick up the slack. So if those sectors do not do that, then the market certainly would have, some consolidation of some sort. But, at 30% of the S&P, tech is still the area that's really most investors are focusing on, of course, and with NVIDIA this past week. Notable, though, that markets really can seem to rally through that, even with NVIDIA having stalled out a bit. So, yes, it is important, but as long as financials and healthcare, which both hit new all-time highs this week on an eco-weighted basis, I mean, that's about 25% of the market, then we're still in good shape.
Yeah, financials sitting on about a 4% gain for the month of August. Healthcare, 5%. Consumer staples at the top of that list, Mark, by 6%. I want to go down to the bottom of that list. When you look at the main S&P sectors, the S&P 500 Energy Index down about 2%. And we're seeing a lot of commodities still under pressure here on a daily and weekly basis. Any chance of a turnaround in that sentiment around these stocks heading into the rest of the year?
I tend to be a little bit more pessimistic on energy. I think both of you look at from a Democratic and also Republican side, there is pressure to keep inflation lower and to ramp up U.S. output in a way that crude will fall. Potentially, we could have more output kicking in the next month with OPEC plus. So technically, the trends have started to turn a lot more negative for energy, and really it's an underperformer and really an underweight in my view, technically going into next year. So that would be an area I would likely avoid. Plenty of great sectors, but that's one that really, if the economy, and it has started to weaken ever so slightly on the fringes, starts to weaken more, that likely would be negative for commodities. And my thinking is that, the demand picture, particularly what's happening in China, very well might not materialize as strong of a fashion, and that could put weight on crude as well.
Is there a sense here, Mark, that when we talk about what the market is looking for, and whether it's the macro data or the moves by the Fed or maybe better or at least more sustained corporate fundamentals, is there any sense here that everyone is kind of on the same page? Or have we sort of reached this point in this market rally, this market cycle, where everything is splintered off, everything is idiosyncratic?
That's a great question. Look, I think that increasingly investors have become more confident with what the Fed is doing and its recent pivot. And I think that is very constructive, but also it's a sign not to get too complacent for the Fed to have a pivot at this stage of the rally. We'll have to wait and see in that regard. It's still a lot of moving pieces. I would argue that recently we've seen some evidence of the dollar trying to bottom out and also treasury yields. And those have been important reasons why stocks have been able to rally. Bad news has been good news for the market. Now, if the economy continues to falter, I would think that continued bad news in the economy is not always going to be good news for the stock market. So that's going to be something to watch. I think we could have a temporary reprieve where rates might bounce and the dollar bounces a little bit, but the trends are very bearish for both heading into next spring. And so I think that's still going to be a source of positivity, I think, for risk assets.
Mark, appreciate you taking the time, particularly heading into a holiday weekend. Be well. We'll talk to you in September. Mark Newton, Managing Director and Head of Technical Strategy over at Fundstrat, helping us count you down to those closing bells. Less than a minute to go here. Stocks hitting session highs. We should point out bond prices hitting session lows here as volume picks up here at month end. Yeah,
interesting that volume would pick up on a day like today before a long weekend. September, by the way, has been the biggest percentage loser for both the S&P and the Dow, going all the way back to 1950. October gets a bad rep, but September is actually worse.
Yeah, absolutely. I was looking at the stock
market almanac.
Yep. And yeah, it doesn't necessarily bode well. But remember, there were some months earlier this year that the almanac said we're going to be good, it turned out to be bad, and vice versa. So maybe that changes at all. We do get the closing bells here in New York, heading into a holiday weekend, and there is clapping and cheering. And in fact, that screen looks a lot different than what it was going to look like just a few minutes ago. A Dow Jones Industrial Average higher on the day by roughly, I can't actually see that, but roughly by about 0.5%. The S&P higher by 56 points or 1% here on the day. The NASDAQ Composite up about 1.2% here on the day. And we should point out all three of those names now posting gains for the month of August. Let's take a look at the Russell 2000, higher on the day by about 0.7%. But we should point out, Scarlett, for the week and for the month, it is in the red.
Okay, well, like you said, the picture really changed in the last 15 minutes or so, because until then, we had seen a steady ratchet higher in the major indexes, but in the last 15 minutes, they really took off. So when you look at the sector performances here in the S&P 500, it's a spinach pie. I'm going to change from pesto pie to spinach pie. Pretty much 23 out of 24 sectors. I'm sorry?
Like spanakopita.
There you go.
Yeah.
There's a little bit of chili, there, and that's the tech
chili?
hardware. Yeah. The tech hardware and equipment index is in the red just barely. But for the most part, you have gains all around. When you look at the best performers in the S&P 500, it is consumer discretionary up 1.9% on the day.
All right, as we continue to break down everything that happened in the markets on the day, on the week, and in the month, let's bring in Amy Orr, who helps to lead our equities coverage here in the U.S. Today, Amy, where we saw the S&P close higher, more than 400 stocks in the green.
Yeah, and one of the big gainers is Intel. We've been talking about it the whole day because our colleagues in Cain and colleagues in San Francisco have been really good in breaking the news about its plan to actually split off its foundry business, which hopefully will turn around the business slightly. It's been really performing really bad. For the year to date, it's been down 57%, but then for today, it's up almost 10% now.
I know you cover a lot of M&A, and is this something that people talk about, whether Intel might be a target in any way or whether people want to buy parts of it?
Yeah, well, for a big company conglomerates, it's always kind of trying to, especially M&A bankers, we'll talk about Goldman later on, people are always trying to actually come up with deals and ways to actually unlock value. And then we've seen not even just in chip makers, but also like J&J, it spun off as Canview last year, and which has been doing well. So there are values to be unlocked from just splitting off some part of the business.
What else are you looking at?
I'm looking also at Lululemon. Well, yeah, the yoga kind of pens maker has also, it gained earlier on, but then it gave up some of the gains, with its sales and profit outlook being lowered, but people are still saying it's very achievable.
But what was the issue here? I mean, we got their earnings report, and I know there were some concerns here about margins, about sales growth, et cetera. But I've always felt this seemed to be kind of like that Teflon stock, right? It was just, it didn't matter what they charged, what they made, how bad they're. Remember when they had those like see-through leggings that they had to like go back on?
Different
but people still kept buying the stock.
That's very true.
Yeah.
The branding is very strong, especially international. Overseas kind of business has actually gained while the U.S. business has kind of been flat. So that's also the reason why people are kind of like, maybe it's not so bad. Well, especially in a time where we're not even sure whether we're heading into recession or not. So people are just being conservative at the moment.
Also, they have not caught on to the baggy pants look.
The baggy pants look? Is that back?
Yeah, well, you have a teenager. Have you seen what his friends are wearing?
Everything
I've seen what he's wearing, and it hurts my soul all the time.
Everything is back to the 90s and like 2000s, right? Yeah. So that's also the reason why Abercrombie is also like back in the news again, because it's staged the best turnaround.
Absolutely.
Yeah.
Did you save all your Abercrombie and Fitch from like when you were younger? Because now you would have been.
I know.
So this is the real turnaround story in retail, right?
Well, hopefully, because fashions come and go, but it does seem like it's here for stay for a little bit. And then like with all the minimalism and all that, people are really going back to the classic looks of the 90s, and then just sleek and
I just listen to 90s music. I don't actually wear the 90s clothes.
You don't have to put the 90s clothes on to listen to it.
I don't know. That would be a bridge too far.
So I've been doing it all wrong. Because I just put on like my troop sweatsuit and the Dookie chain and the Kango, and I just walk around the house.
Especially a bow tie on a Friday before Labor Day holiday.
I got to dress this as a Tom Keene memorial bow tie. Rest in peace, my friend. All right, you got decliners?
I have decliners. Let's see if they're actually declining at the end of trading today.
He's not actually dead, so just nobody email me on that. He's alive and well.
He's taking a break. He's resting right now, as he should after a long week. Let's take a look at Supermicro. Yes, it is down on the day, resuming its decline, and it closes out August as the S&P 500's worst performer for the month. I mean, what hasn't gone right for this company this month? You have allegations of accounting problems by a short seller, a delayed 10K filing, which Supermicro blamed on needing more time to assess internal controls.
And Amy, I mean, this was like kind of for a short period of time was kind of like the darling AI stock. I mean, not quite an NVIDIA, but I mean, it didn't like rally like 100% or something in like a span of a few months.
Started to fall.
Yeah, and then it actually tapped money through convertible bond market as well. And then we're all like, it's very rosy as well. But like as we've seen over the past 2 weeks, like the AI story is kind of like on shaky grounds now.
Yeah, absolutely. All right, let's take a look at Elastic. This stock held on to its losses, off by 27%. It's an enterprise software company, cut its full year revenue forecast, leading to a downgrade from Bank of America. I was looking at it. It's incorporated in the Netherlands, but based in the U.S.
But we've seen a lot of these enterprise software companies and application software companies definitely underperform over these last few months. And in fact, I think when you look at the tech indices here, that's been a big part of the drag.
Yeah, because AI story is actually hurting some of the software companies. If they're not keeping up with the AI story and not adopting it, they might actually lose out.
Yeah, well, I mean, gone are the days where you could just throw the words AI into your press release and get that pop, right? Alnylam Pharmaceuticals, ALNY is the ticker here. That's another big decliner. 8.5% drop here.
This was crazy.
Yeah, the full results from a drug trial showed its treatment for a form of progressive and increasingly fatal heart disease disappointed investors.
Right, but it was also the data point, the previous data point they get was actually in error. So they had to effectively correct that. So it kind of caught a lot of investors off guard who thought the data was a little bit better here. I do want to turn real quickly to the yield space here because there was actually a lot of activity there. And I think, and you probably know this, Amy, this is going to be a big factor heading into September with the Fed, everyone anticipating this rate cuts here. We did see modest increases in yields on the day. We're now at 3.9 on that 2-year yield and right around 3.9 on that 10-year yield. But on a monthly basis, you actually had some pretty good returns here. And I wonder what the correlations are right now between what we're seeing in yields and what we could potentially see in equities once the Fed does indeed make good on what everyone thinks they said they're going to do.
Well, it's really boils down to data, right now, because we're definitely going to have one cut in September, but how aggressive it's going to be really depends on the data. And then, like, if it's going to be very aggressive, it really puts us into the recession mode, which is not a good space to be in. And sometimes, like, technically, rate cuts are good for equities, but if it goes into recession territory, then it's going to hurt a lot of businesses. Then that's not a good look.
Anything that takes investors by surprise gets people thinking, what does the Fed know that we don't know? What is it acting on that we're not confirmed on just yet.
Yeah, and we should point out, too, that, we talk about this potential for a recession. Obviously, a lot of that ties into consumer spending. There was a great story out today with the interview with the executive over at MasterCard, how they want to get rid of kind of basically the card itself. So more like biometric stuff and tokens and things like that. I don't know. Are you like the kind of person who still swipes your card, or do you use a phone, or what?
I use my phone all the time. That's why I don't bring my wallet. And it kind of like bites back on me sometimes. But then that's also the competition, right? Because the whole financial industry is going through an kind of earth-shattering kind of like shakeout. So essentially, with all the new kind of technology, so we don't really need to actually have a card. And these days, there are technologies where you can swipe on the street if you just have your card with you. So like that's for protection, but also like easier for you to spend money.
Yeah, well, whatever to reduce friction, right? At some point, you could someone will scan your eyeball and you can purchase something.
Well, I would say, have you been in like Whole Foods lately? Some of them, they have this, you just do your fingerprint, your palm or something on it.
What did you buy when you were there?
Well, I use a regular food, Scarlett. What do you mean? What? What do you? See, this is what I have to deal with, Amy. Anyway, thank you for joining us. Amy Orr, who helps lead our equities coverage here at Bloomberg, helping us break down all the market moves on the day.
What a good sport. She, gave us 3 gainers, and it helped that the market rallied into the close. I'm just relieved that the decliners I picked out actually stayed lower.
Absolutely. All right. Well, Amy is actually going to hit the road right now, as a lot of people are already out there traveling for the extended 3-day weekend here in the United States. We're going to check in with Becky Blaine. She's a travel industry editor over at The Points Guy. She's going to update us here on just how much traffic we're going to see out on the road later tonight. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm still Romaine Bostic here. And we are still here despite the Labor Day holiday has already kicked off. And, well, it might be a good holiday for some investors because you saw some pretty sizable gains on the day. The chart behind me, those are your monthly numbers here. You're looking at S&P 500 that was up more than 2%. And I put the equal weight S&P 500, and I did it for a reason. Second straight month where we've seen outperformance of that broader equal weight index relative to that cap-weighted index. Now, it was a modest outperformance, just a fraction of a percentage point here. But that is the breadth that a lot of people were asking about earlier this year. Well, we're finally getting it here in the summer months. We should point out the best performing sector this month, well, it wasn't tech. It was consumer staples, it was real estate, it was financials, it was utilities, and that's been the trend for the last 2 months now. Tech is much lower on that leaderboard, and once again, that might be a good thing. If you are a bond investor on a total return basis, you made money in the month, 2.81%, at least on an aggregate basis here. And if you are in the commodity space, still some concerns there. Crude oil down on the day, the week, and the month by about 1.5%.
I want to zero in on the tech sector here because when you look at what happened over the course of a month, Super Microcomputer was the worst performer in the S&P 500 in the month of August, down almost 40%. For today, it closed down about 2.5%. And there's a whole number of catalysts here driving this company lower. Allegations of accounting problems by Hindenburg Research. There's also disappointing earnings report and a delayed 10K filing, which Super Micro blamed on needing more time to assess its internal controls. So all of that adding up to a big drop for Super Micro. In terms of the other gainers on the day, Intel has had a rough go of it, we know, for the last couple of months. But on the day, it did close up 9.5%. This is after Bloomberg News reported that the U.S. chipmaker is discussing various scenarios, including a split of its business between manufacturing and product design. And, of course, the hope here is that it can get itself back on track and kind of restore some of its former glory. Marvell Technology gaining more than 9% on the day after the chip device company's second quarter results beat estimates, and its third quarter outlook for revenue looks pretty strong. There's a lot of hope as a result that perhaps its AI-related applications will fuel growth moving forward. But when you bring it all together, our top story this hour, and on this day really, is a record-breaking day and a record-breaking summer when it comes to air travel. According to the TSA, the Friday before the last long weekend of the summer, which is today, will be the busiest, with more than 17 million people walking through security checkpoints across domestic airports. Yet, spare a thought for those conducting the screenings and serving passengers on flights. Bad behavior is actually getting worse. We're going to get into all of that, as well as the workarounds that travel pros are recommending later this hour.
Absolutely. But we do want to get back here to the markets, how they finished out the month of August and maybe potentially where they go in the month of September. It is our Factor Friday, and joining us now is Chris Cain of Bloomberg Intelligence to help us walk us through that. We talk about a pretty phenomenal month, Chris, for stocks, also for bonds on a total return basis. And we're heading into a month where everyone is expecting a rate easing cycle to start. And it really does start to raise a lot of questions about the correlations between stocks and bonds and what we should be expecting.
Yeah, I think this is something that's kind of underappreciated in the market right now, and that is that the correlation between stocks and bonds is actually one of the highest levels we've seen in 50 years. So to be very clear, I'm talking about the price of stocks and the price of bonds.
Okay.
If you look at that on a rolling 12-month basis, that's about positive 0.8 correlated, which is a 98th percentile reading, again, over the last 50 years. So one of the highest, readings we've seen. But the one, I would call a coincident thing that we found with this stock-bond correlation is just simply inflation, whereas when inflation is high, you tend to see stocks and bonds move together, that correlation be high. When inflation is low, you tend to see the opposite. If you look at the average inflation over the last 50 years, it's been about 3%. The average stock-bond correlation when inflation is above 3% has been positive 0.4. When it's below 3%, it's been minus 0.2. We just crossed below that 3% level, and again, we're at positive 0.8 right now.
Wow.
So we think that's going to come down pretty dramatically over the next coming months, which is good news for diversified investors. It might not feel good sometimes when one goes up, one goes down, but it does decrease the risk of your typical 60-40 portfolio.
Okay, so that's the cross-asset relationship. Let's just dig into equities a little bit more, because when we do talk to fund managers, they all say the same thing. They're seeking quality. What can you tell us about the fundamentals of that quality factor, at least here in the U.S.?
Sure. So the quality factor, is one of those factors where people have their own definitions. We kind of try to keep it simple. We say high quality stocks are those with high profitability, so things like return on equity, return on invested capital, and low leverage, so things like debt to market cap. When you look at the median price to sales ratio, or the median valuations of high quality companies, that's about 4.5 times sales right now. Compared that with low quality companies, that's only about 1.4 times sales. High quality being roughly 3 times higher in valuation than low quality is pretty extreme, about an 87th percentile reading going back to 2002. So it is very expensive, but the profitability of this stuff is really high. So the median ROE for high quality companies is about 35%. For low quality is only about 5%. That 30 percentage point spread is again pretty high historically. So that could justify at least some of the very expensive valuations, the fact that they're so much more profitable.
So what does the performance look like so far in 2024?
It's been very good. Typically factor investors will look at, factors long short because that really isolates the effect. You could think about that as one group of stocks versus another. So BI quality, which is again, half profitability, half low leverage, is up about 8.5% this year. So high quality beat low quality by about 8.5%. When you look under the hood there, it's really the profitability component that is driving that. So forming very similar long-short portfolios using things like return on equity, return on invested capital is up about 10 to 11%. Low leverage is only up about 2%. Ours falls towards the middle of that, which is logical since it's used both of them, about 8.5%. But it's really that profitability component that is driving the quality's performance.
Chris Cain, really appreciate your giving us, of course, the wrap-up on fundamentals here and on the different factors and their performances. Chris Cain of Bloomberg Intelligence. We want to segue now to the fixed income space and take a look at this week's Muni moment, because a new report shows retail investors who hold the largest share of municipal bonds pay roughly twice the spread that major institutional investors pay when trading recently issued debt. Bloomberg's Nick Querolo joins us now. Nick, why is this? Why are they paying double what institutional investors pay?
Yeah, it's a great question. I think data in the municipal bond market is pretty hard to come by and very difficult to parse through. So this report was really interesting to us. I think the simple explanation is that we don't know who's making these trades, but that researchers were able to use a proxy. Any deal that was $100,000 or smaller, they assume is a mom and pop buyer, a retail buyer, and anything $1 million or larger was a large institutional player like a bank or something. And the most logical explanation is that they just have more pricing power. When you're placing a large order, you have a little bit more leverage to demand more attractive yield.
Is there a sense here, that this could change at all? Because we've seen a lot more retail participation in this space in a way that we hadn't necessarily seen, 10 or 15 years ago here. So at some point, I know that gap's not going to completely narrow. It never is for institutions versus retail, but it's got to narrow a bit, doesn't it, Nick?
It's a good question. I think it could. There was a lot of variety year over year. This is measured over a 5-year average, and it makes sense that it would begin to narrow as we start to see more retail buyers participating in the market. I think what was also interesting to me was just this idea that they only measured the trades in 1 week after they came to secondary market. So they were measuring the spread between the primary offering and the very early stages of trading in the secondary. And that's because the muni market, compared to many other fixed income markets, is very, very stale. It doesn't trade a lot. Usually there's this kind of flurry activity right after the deal comes to market. And then in many cases, it just sits in someone's portfolio for years, if not decades. Right. And so they chose a pretty interesting window to choose to measure.
So what are people in the industry saying about this? Is this problematic? And if so, how problematic is it?
I don't think it's necessarily problematic. I think, the underlying findings weren't totally surprising. I think the scale was a bit surprising. Took a lot of kind of intense analytical power to understand just how big the difference was. They found that, an average spread for a retail buyer was about $10 and an institutional buyer was about $4.40. So I think the surprise was really the scale of the difference between those two, especially because retail investors just make up such a massive part of the municipal bond market.
All right, good stuff. Nick Querolo, thank you so much. Bloomberg's Nick Querolo covering munis for us in today's Muni Moment. More and more, you definitely hear people talking about investing in muni bonds. And of course, the appeal there is because it's tax-free. Yeah, tax-free. And have you seen the returns, at least as of the last couple of years? I mean, we always talk about these short-term cash accounts getting 5%, but, you're getting that and then some for some of these muni deals. Yeah, so it's going to take a lot to convince people to give some of that up to go into other corners of fixed income or, back into equities that's not tech. Back into equities. Oh. Coming up, we've got the top three where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Morrissey. No last name needed, just one name, Morrissey. Following the announcement that 90s Britpop band Oasis is reuniting for a tour, Morrissey has revealed that his former melancholic 80s band, The Smiths, also got an offer to tour, but he says he said yes to the offer while Johnny Marr ignored it. Yeah, I love this story. Of course, obviously, the whole Oasis cropped up. As I guess this had something to do with it here. This has a lot of flashbacks for me because my freshman year of college, my roommate, all he used to do was listen to this Morrissey album, that and the Kate Bush album, on repeat all day long for weeks on end. Melancholic until he finally got a girlfriend. So, Justin, if you're watching out there, I love you, brother. Are they going to get back together or not? No. They're just too far apart, There's too much personal animosity. Yeah. Morrissey's politics are very different from Johnny Marr. Yeah, he's had some interesting comments over the last few years. He supports Brexit, among other things. Yeah, how'd that go? I guess he's happy where he is right now. Who needs this more, Morrissey or Marr? Morrissey would say Marr because Morrissey's still touring. Johnny Marr does, by the way, tour with New Order, but as a special guest as opposed to as his own headline tour. Yeah. So, okay. All right. Well, Morrissey was very kind to point that out on his website. Very kind, and I'm sure that's exactly why he did it. I'm keeping an eye on someone else, and not necessarily a household name, Treb Heining. I think I'm pronouncing that right. You probably never heard of this guy. I'd never heard of this guy before today. But when you see all those balloons fall down at political conventions or at the Super Bowl or at Disney World, this is the guy behind it. 100,000 balloons at the most recent convention, the Republican National Convention in Milwaukee. And Bloomberg had a chance to basically just go behind the scenes. How do you get all these balloons inflated? How do you get them up in the air? How do you ensure that they drop in a way that they're supposed to drop? This is a huge logistical challenge. And I think this guy, frankly, is a national treasure. He owns the process, right? He actually started off as a balloon salesman at Disneyland when he was 15 years old. So he's been doing this for an awfully long time. And he still supplies balloons to Disney parks around the world. Yeah, and I love it. I mean, this just seems like a great job. I mean, I'm sure for him it's actual work. But, for us looking in, it's like, wouldn't that be cool to just blow up balloons? And, his August, he had a really busy July and August. Let's just put it that way. So, all right, third on the docket. Come in and just for the I would love that. We're going to have to
the market
broadcast that.
close, all the balloons just come down. Red ones on the down days, green ones on up days.
All right, third on the docket is Princess Martha Louise. She's a Norwegian princess who is fourth in line to the throne.
Okay.
She is set to marry an American self-described shaman on Saturday. 2 years ago, she said she would no longer officially represent the Norwegian royal house in order to work closer with her fiancé, who says that he communicates with a broad range of spirits.
So this guy is interesting. He's a sixth generation shaman. Just to be clear.
Sixth generation.
I don't know exactly what the first 5 generations were, but this came on my radar. They started dating a while ago. I think they got engaged back in 2022, which was when I first heard about him. And of course, the royal family is in a complete tizzy over it. Anyway, good luck to those 2 crazy kids there. When we return, birthday wishes for one of the greatest investors ever, Warren Buffett. And a question before we go to break. What was Buffett's biggest investment ever?
Bank of America?
The answer when we come back. All right, on this day in history, August 30th, 94 years ago, in 1930, Warren Edward Buffett was born. In the history of his success, it almost seemed preordained. The son of a U.S. congressman, Buffett exhibited an early and entrepreneurial spirit, starting multiple businesses, selling chewing gum, magazines, golf balls, pinball machines, all before he graduated high school. After completing his collegiate studies, though, Buffett went to work at his father's investment firm and later at a partnership run by famed financial analyst Benjamin Graham. By 1956, at just 25 years old, Buffett founded his own investment company and a year later met his future business partner, Charlie Munger. Within 6 years, Buffett was a millionaire. But it was in 1965 when Buffett made a purchase that would change his life, paying around $8 million to take control of an obscure textile company called Berkshire Hathaway. While the textile business itself was a dog, Buffett was able to pivot the business into insurance after buying National Indemnity 2 years later, creating a foundation for billions of dollars of future investments that would make him one of the richest people in the world. Those investments are vast and numerous. See's Candies, Ogilvy and Mather, The Washington Post, Cap Cities ABC, Coca-Cola, Gillette, Geico. I can go on. And that brings us to our question of the day. Buffett's biggest deal ever, what was it? Well, it might have also been his worst. In 2016, he purchased aerospace industry supplier Precision Castparts, a more than $36 billion deal, including debt, his biggest ever. But less than 5 years later, Berkshire was forced to write down that deal value by $11 billion. In fact, in his annual letter released in 2021, Buffett called that purchase a mistake, saying he paid too much for it, miscalculating the trends in the aerospace industry. Still, investors have been forgiving, and they have reason to be. Berkshire this week became the first U.S. company outside of the tech sector to surpass $1 trillion in market value. Its Class A shares have gained 31% so far in 2024, its best year in a decade, outpacing the S&P, outpacing the NASDAQ, even outpacing the red-hot Philadelphia Semiconductor Index. In fact, over the last 30 years, Berkshire Hathaway stock has provided investors with a total annual equivalent return of 13%, an average return that no major benchmark in the U.S. has matched.
And that is why he's a legend. Also, the fact that he can be candid and admit when he made a mistake. I think that endears him to a lot of people because investment is a lot of mistakes and then the few big wins. All right, this is a great segue, by the way, into our next guest, who is building her own financial empire by offering users investment guidance to become financially secure themselves, maybe even millionaires. It's time for Next Up, where we highlight the entrepreneurs and founders moving the needle for our economy, markets, and technology. Here in studio with us is Ashley Fox. She's CEO of Empify, a fintech startup. Ashley, thank you for joining us.
Thank you for having me.
Key to understanding Empify's mission is why you started it. And your backstory is that you were working on Wall Street and you left that job, and shortly thereafter, things went south. Can you take us through what happened and explain how that set you up for Empify?
So I work for one of the largest banks in the world, helping millionaires and billionaires stay wealthy. So every day I'm in the bank accounts of millionaires and billionaires, and I felt like for something we're using every day of our life, why is it not taught in our school system? You shouldn't have to major in finance or work on Wall Street to get exposed to this information. And so I'm from Philadelphia, so when I went back home, people thought I had a lot of money. But working with clients that had at least $25 million or more, I realized that there's something the world needs to know. So I ended up leaving Wall Street with the intent to financially empower the 99% that Wall Street often overlooks. created the word Empify, which is a merging of the word empower and modify together, with the intent to shift the mindsets of people who feel like they don't deserve to have wealth, didn't grow up with a lot of money, and show them how to build it. Now, when I left Wall Street, nobody told you that when you run a business, you don't make money every 2 weeks like a job. So I ended up losing everything. Got kicked out of my apartment, but I couldn't unsee the wealth that Wall Street exposed me to. So because I knew that it was possible, I knew that I could show the world how to invest, how to plan for retirement, how to pass down their wealth to their children because I saw it on Wall Street.
So that's so interesting, the fact that you lost all your money afterwards because, you were still spending as if you were working at this big bank. How does that inform the approach that you take at Empify in terms of teaching people how to manage their financial futures?
I think what it did to me as a founder, it allowed me to connect with the people that I serve. Not everybody has the opportunity to go to Wall Street, but everybody has the opportunity to learn how to invest. So I think it allowed me to connect with my audience a little bit more because I knew what it felt like not to have, but I knew that it was possible for me to create. So showing people the basics. If you're spending money at companies, these companies are generating revenue because of you. What if you own stock in those companies? And what if you started small? What if you learned how to build big? And really pushing people, giving them the education, translating that information into a digestible language so that people feel like, hey, I can do this. I can start small, I can build big, and now I'm in an environment of people who support me, who want to guide me, and really show me how to get this done.
What's the foundation of that, though? Because a lot of times when we talk about these types of programs and stuff, the first thing everyone wants to ask is just tell me what stock to buy or what investment to get in here. What you're doing is way, way more deep than that here. Just kind of talk about the program. You have a 12-week training program effectively. What's the main thing that you want to get across to those people when you're teaching them that?
So when it comes to our programs, so we have programs in school systems, we've done programs in prison systems, we've partnered with community colleges, recently the Community College of Philadelphia. And we have our membership-based platform. And so imagine like the Netflix of finance, where adults in over 24 different countries, thousands of people of all different ages have access to financial tools in the palm of their hand. So coming in, how do I open a brokerage account? How much do I start investing with? But also showing people just how to fish. How about we start to think about what you know, use, and believe in, because it's a lot easier to research a company that you know what they do and how they operate, and then you start small and, again, build big over time. So it's really showing people the how and the why is important. Because just because you didn't grow up with money, it doesn't mean you don't deserve to have wealth. I always tell people wealth doesn't have a color. Therefore, it looks like all of us. So how can we show adults, how can we show children how to effectively build by starting with who they are and what they have?
In building Empify, and particularly where you want this to go next here, have you been able to attract investors, not just to you, but really to the vision of what you're trying to accomplish?
So yes, I've been approached by investors. We haven't taken any investors, but for me, it's for people to be able to see like, hey, I can connect with her. I want to build with her. And also showing the results. Our members in less than 2 years have invested over $6.1 million. And these are brand new investors who didn't have a lot, but collectively we're building a lot together. And so I think showing who I am, showing what we do, connecting with the everyday person. And just recently, we were featured on the Inc. 5000 list as one of the fastest growing companies. I wouldn't have imagined this happening, but I know that we're onto something. I know that there are people who want to build, but want to feel like they can do it, that they're safe, that they're comfortable, and we're also showing you how to get it done.
So when it comes down to it, this is very much a training boot camp. It's personalized and it takes you through it and it requires time. What about people who get to a point where they feel comfortable enough with the basics of investing and they want to start to build generational wealth? How do you build on that?
So our app is filled with tons of boot camps. So we have the life insurance boot camp, the retirement planning boot camp, the legacy planning boot camp. So I bring individuals like my estate attorney, like my life insurance agent, and partner with financial advisors so that they're no longer doing the basics. Now they're executing on all the information that they're learning. So now how can we invest for our children? How can we have the conversations with our family? How can we set up a will? How can we set up a trust? Because when I was working on Wall Street, when you have at least $25 million, you don't just walk into a branch. There's a holistic experience that is set up for you. So what does that look like building that for the everyday person on a smaller scale?
Very well said. Ashley Fox, really enjoyed meeting you. Thank you so much.
Thank you.
She is CEO of Empify. It's a fintech startup. Let's just give you a glimpse of what happened in trading today because it was kind of a roller coaster ride. We finished the day up in the green by better than 1% when it comes to the S&P 500, the NASDAQ 100 doing even better. And this, of course, as treasuries fell, pushing yields higher. The core PCE data came in and pretty much delivered as expected, remained, indicating that we're going to get a rate cut in September.
Yeah, there doesn't really seem to be any real data bump here that would actually cause the Fed to deviate from its path. But you talk about that big activity that we saw heading into the close, that volume pickup up as a lot of people rebalance at the end of this month. The question is, do those trades get unraveled when we get to September 17th, 18th, and whatever Jay Powell says, we might get a cut. We might not necessarily get 50 basis points.
Yeah, well, first we have to get through the jobs report, which is next Friday as well. So a lot of hurdles until we get to that September 18th decision. This is The Close on Bloomberg.
All right, well, Labor Day, is kind of here. The Labor Day weekend here in the U.S. underway, and travel is expected to reach record levels. The TSA says it's prepared to screen more than 17 million people today through Wednesday. Tom Black of Bloomberg Opinion, though, is warning folks to beware of passenger behavior, with the number of unruly passenger cases rising this year, according to the FAA. Tom Black joins us right now to talk a little bit more about this here. And Tom, thankfully, I'm not getting on a plane this weekend, but I have been on a lot of planes over the last few months here. And you've definitely, anecdotally, I could say, definitely seen a little bit of a shift in how we are behaving.
That's true. And it started with a pandemic. It's pretty clear. I think the mask mandates created a lot of that chaos, but unfortunately it's not dropping as quickly as we'd like to see it. So I don't know if there's some kind of lingering effect from that or what exactly is going on.
Well, sometimes it's due to frustration with the whole security check process. You know, for domestic flights, it used to be you could just show up at the airport maybe 70 minutes before your flight. Now, at least for New York, you have to get there 2 hours in advance to get through all of the security check. And yes, I know that there are different programs like TSA PreCheck that make things easier, but it feels like that's still a small proportion of people who actually do sign up for it.
That's true. There's about 20 million people signed up with that program. The FAA is encouraging more folks so that they can try to process them quicker. But I would say that these rules have been around for a while now, right? 9/11 created some of these extra checks, but that was quite a bit of time ago. And then, of course, if you look back at the numbers at 2018, 2017, they're well below where we're at right now, 3 and 4 times higher now with these unruly incidents that we're having. So I get what you're saying, but still, there's a behavior problem there, and they're trying to crack down. They have a zero tolerance program, but people still are getting themselves into trouble.
Well, let's assume for a second everyone behaves themselves this weekend. Tom, I mean, as we pointed out, the TSA expecting some pretty high numbers here, 17 million passengers, I think starting from Thursday through next Wednesday. That would be up about 8% here. One interesting data point that I saw, and I think you even referenced it in one of the columns that you wrote, was the average price of airfare is actually lower today than what it was, I don't know, maybe a decade ago, which kind of surprised me because it feels like every time I book a ticket, it seems like it's more expensive than it was the last time I booked.
That's correct. We had a big drop in prices when they deregulated the industry, but that was several decades ago. But from just 10 years ago, I would say the entrance of some of the low-cost carriers have helped put some downward pressure on fares. Of course, you have to be brave enough to get on some of these airlines that don't have a very good on-time performance. So that's kind of the trade-off.
Oh, so basically, like if I don't fly Frontier or Spirit or something like that, then
that's right.
Okay. You don't have to say the names. Yeah, I've never been on them, so maybe that's why my prices aren't going down.
You got to try it sometime. Be brave.
Thomas Black of Bloomberg Opinion, really appreciate it. We'll try to get Romain on one of those discount carriers, but it's not really in keeping with his reputation, right? He's shaking his head at me right now. Thank you so much.
Gulfstream's only for me.
Of course. He only flies PJ. Listen, for more on what to expect this holiday weekend, let's bring in Becky Blaine, travel industry editor at The Points Guy. So, Becky, we talked about the frustration that brews when you have to go to the airport and get through the security checkpoints, especially ahead of long weekends like what we have right now. 17 million people expected to go through security checks right now. I know that you've compiled some tips. The obvious ones, of course, include getting there early, but that doesn't change the frustration that you might feel. You also talk about making backup plans. Walk us through what that means, especially when you have points, miles, and other things like that at your disposal.
I think we're having some issues with
Becky, can you hear us? Oh, great.
To make a backup plan, we suggest using those points in miles. So following your flight and seeing where the plane currently is now, where it's coming from. Is there weather in that destination that might potentially delay your flight? And then booking maybe a backup flight on your miles, because you can get those miles back. If you don't check in for that flight, you can have those miles redeposited back into your account. So I've done that personally myself. I know a lot of TPG staffers do that as well. And it just gives you that reassurance that if your first flight doesn't go according to plan, you do have that backup. And then using those TSA and Clear, expedited security lanes and making sure that you have that membership. And many credit cards will offer you a statement credit for those memberships. And so that is a great, way to get through security faster, because TSA estimates without pre-check, your average wait time is 30 minutes. Yeah. With it, it's less than 10.
I just want to stop you there for a second, Becky, because I'm a little confused as to all the options now when you approach the security lines here, because you have TSA pre-check, you've got a Clear, you've got, of course, priority and first class lanes here, and I can never make sense of which is faster. I always seem to be in the slower lane here. What have you found is the best approach to get through? Is it one or the other, or you just need all of them and then just pick when you get there?
I have all of them, and I kind of
course,
gauge it when I arrive and see what looks like the shorter lane. But TSA does a really good job now with the scanning of your driver's license and taking a quick photo for photo identification. Those photos are deleted pretty instantly after that, though. That is getting passengers through very quickly in those lanes. And we just wrote a story on site on thepointsguy.com about Clear and, is it worth it or not, and pros and cons and things, because many people get frustrated. They're in the TSA line and they see those Clear customers come and kind of jump the line, so to say.
Yeah, it's enraging.
And then the other thing that you mentioned was, priority boarding and things like that. And that has to deal with your airline loyalty program. And if you hold elite status with the airline, which can be, different from airport to airport when they have those lanes. Those are mostly for like baggage check-in and things like that as well.
Okay, you're hitting upon a sore spot here, because I traveled for business recently and I got through a security check pretty quickly because I was flying business. And then I had 2 hours to kill because I got to the airport so early because I anticipated this long, unfriendly process. And then I wanted to go to the lounge, but I couldn't get in. The lounge is now off access to most people unless you have the right credit card or you're flying international.
That is true. And, I have status on American Airlines, and unless I fly international, I can't access the Admirals Club unless I have an Admirals Club membership. And then, the right credit card you mentioned, like I carry the Platinum card by American Express. That gives me access to American Express Centurion lounges and Priority Pass lounges as well. So then that gives me a few additional options if for some reason I can't get in one lounge or another one is crowded. We've seen that a lot. Lounge overcrowding kind of peaked during the pandemic with this, rush back into travel. And we've seen it start to taper off a little bit as some of the carriers have changed their access rules or changed their credit card, co-branded credit card rules for access and things like that. But it's still not where it could be as far as, spreading out guests.
Yeah, and it's interesting. I had this similar experience where I got denied entry to the Admirals Club, a club that I'd been in a zillion times, but apparently the rules changed and I didn't know about it. It raises the question, though. Becky, we were kind of giggling here when you kind of mentioned that you have all these programs, as we would expect anyone who works for TPG to do. But for most of us, we just don't have the patience or the time to sign up for all these things. Where should we steer ourselves? If we just want one or two options to try to cover enough bases, maybe not all the bases, should we just go straight with the airline type of credit card? Is it better to do Amex or what? What's the best deal?
It just depends on what airline you might fly the most and what your home airport is. For me, I'm based in Phoenix. That's American Airlines. It's a hub here, and that tends to get me anywhere domestically or internationally that I need to go through code share partners and things like that. So I also hold that credit card, and many of the airlines have changed their spending requirements on the credit card. So you can actually earn elite status without ever stepping on a plane, just through credit card spending. So there's many different ways that you could access an elite status program for traveling without traveling as much. And it just has to do with, how much you're willing to put on the credit card. And for a lot of us, we put everyday expenses because we pay it off. And you're earning points on all of that everyday normal spend that you would have.
It basically sounds like you have to read the fine print or know someone at the points guide to be able to really figure out what works best to your advantage. in terms of the actual points that you do accumulate on your credit card or the miles that you accumulate from flying, what do we know about in terms of how much the airlines have devalued some of those points over the past couple of months?
So we have covered that on our website, and they have devalued. Depending on the program, there have been some devaluations, and it just depends on if they're switching to a dynamic award pricing chart or how they're pricing out those award seats. And it might be that a route or something that was mileage based was 12,000 points before is now 15,000 points. And so that's when we talk about, what we're seeing when we talk about devaluations. It's going to take you a little more points or miles to maybe secure that same ticket than it did last year or the year before.
All right, Becky, great advice, great insights. Becky Blaine, travel industry editor over at The Points Guy here, as a lot of us are prepared to hit the roads and the skies for the Labor Day weekend.
And that is why people are all mad and in a bad mood when they get on the airplane.
Yeah. Well, this is why
they couldn't get into the lounge ahead of time.
Got to get you one of those Gulf Streams. I keep telling you that. Anyway, still ahead, of course, after you get back from the holiday weekend, it's going to be a busy week for markets. We're going to set you up for what to watch next week. This is Bloomberg. As we close out the week and the month of August, let's push ahead to what markets are going to have their eyes on when they come back into the holiday shortened week. Of course, Monday is Labor Day here in the U.S., so markets are closed. So let's get right to Tuesday, Scarlett, because we do have some economic data everyone will be paying attention to.
Yeah, global manufacturing for August, it's a final read, and it is expected to come in below that 50 mark, which indicates contraction rather than expansion. And then we'll also get construction spending and some prices paid components for ISM manufacturing.
We're also going to get on Wednesday some interesting economic data, those JOLTS data, durable goods, trade balance, and your favorite, the Fed Beige Book.
The Fed Beige Book, where everything is moderate or modest.
and anecdotal. We also get earnings on Wednesday as well. Some of these could actually be interesting on Wednesday.
Yeah, Dollar Tree will be really interesting because of what Dollar General had said, which is that their customers are really struggling and basically not able to spend the way they were before, which is interesting given that Walmart has done so well.
Yeah, absolutely. On Thursday, we get more earnings out of Broadcom and DocuSign. We also get some economic data, including weekly jobless claims and services PMIs, and then something else is happening on Thursday as well.
Yeah, the NFL season begins. We're going to see a game in Kansas City. The Baltimore Ravens will play at the Chiefs, and of course, that's the big one. Taylor Swift, do you think she'll be there?
I hope not. And then on Friday, we get more economic data. And of course, this is the granddaddy of them all, that monthly jobs report, the last big one before the big Fed meeting. Scarlett, it's Labor Day. Why are we still here?
We're almost done.
All right, I'm done. Say goodbye.
He's taking off his bow tie.
Yeah.
Balance and Power's up next. Have a great evening and a great long weekend. This is Bloomberg.